The overall market correction has made some of the highly valued and fundamentally strong companies look attractive. One such company is Endurance Technologies. Its stock price has fallen by more than 27% from 52-week high in November 2021. Market correction, demand concerns in Europe and shortage of semiconductors, which led to production cuts by OEMs, proved to be headwinds not just for the business but the stock as well. However, we believe the company is a global force in aluminum casting, suspension, transmission and braking products. We continue to be upbeat on Endurance primarily on the back of its significant presence in the two-wheeler segment, where EV adoption is gaining pace quite rapidly and has a strong order book. Endurance put up a decent show in the quarter gone by despite commodity-linked cost pressure and shortage of semiconductors. Its top line grew 1.7% QOQ. Despite commodity inflation, its EBITDA margin contracted merely by 100 basis points quarter-on-quarter. Geographically, India business outperformed Europe as the shortage of semiconductor chips eased. Europe business registered a sequential decline of 5.1% in top line because of chip shortage and rupee depreciation, whereas India business grew 4%. India business outperformed the two-wheeler industry where growth remained muted in the quarter gone by. The outperformance was led by an increase in content per vehicle, new products and new businesses. Europe margins expanded by 170 bps YOY, however, it contracted by 190 basis points for the India business due to weak product mix and higher commodity-linked cost pressure. Remember, Endurance generates most of its India business revenue from two-wheelers. It has a very strong position on the back of its technologically advanced product range. It is therefore the best proxy to play the growth in the two-wheeler space. It's important to highlight that Endurance continues to outperform the underlying industry. Domestic two-wheeler sector registered a year-on-year growth of 38%, whereas the company's revenue grew by 40% in the segment buoyed by market share gains and new products. Management has highlighted that the long-term outlook for the segment continues to be encouraging for India, as is evident from the order schedule. Furthermore, the preference for personal transport coupled with the opening up of broader economy will boost demand. In terms of Europe outlook, management has highlighted that supply constraints are easing and that should beef up production by OEMs. This will in turn boost the top line for the company. Additionally, to grow in the international market, the company has acquired an Italian company which is focused on friction material and components for braking system like brake pads, thereby further expanding its product portfolio. We expect Endurance to outperform the industry by adding new clients and increasing its wallet share from existing ones. For India business, it has garnered new businesses worth 440 crores in Q1. This includes EV orders worth 110 crores with a total EV order book of 480 crores. EV orders commercial supply will start in FY23 itself and peak in FY24. Further, the company continues to focus on higher value-added products, which include brake and clutch assembly for 200cc plus motorcycles, ABS, paper-based clutches, inverted front forks and fully machined and semi-finished castings. In fact, the company has already commenced supplies of ABS and brakes for 200cc plus motorcycles from September 21. The supply of clutch plates has also commenced. Despite the weakness in Europe, the company had won new businesses worth 14.3 million euros in Q1. Such strong order wins give it earnings visibility in the near to medium term. Management is focusing on cost efficiencies, higher value-added products and import substitution to improve its operating margins. They're renegotiating contracts with clients to pass on energy cost inflation as well. They, however, have not seen much success. They're only a 5% success on this front so far actually. Endurance is currently trading at 24.5 times FY24 projected earnings, which is at a 25% discount to its 6-year average value of 32.7x. We think the current valuation is reasonable given its stellar financial track record and therefore advise investors to accumulate the stock in a staggered manner. Of course, there will be some risks to watch out for as well. Any slowdown in demand could hurt financials. Moreover, adverse commodity prices could increase raw material costs and impact operating profitability.